All right, we have more changes unfolding in the U.S. real estate market and over at one of the largest asset managers in the world. Changes that have Blackstone Mortgage Trust heading for a cliff. This is a shocking story, folks, and is only seeing the light of day because of premier research firm and hedge fund Muddy Waters, who dug into Blackstone's loan book and uncovered what they say is, quote, such a big number of loans terminating next year, it risks them being completely wiped out by these losses. All of this just released a few days ago, which has since caused like a wave of selling to unfold. Wait till you hear about this. But more importantly, why is a company like Blackstone in this position? Almost $1 trillion in assets under management, yet grasping at straws, coming out on the defensive, trying to rebut this report. Well, we're going to look at what's happening, who the man behind Muddy Waters is, why he knows what he's talking about, and what's causing this behemoth of an asset manager to be in this vulnerable of a position. But before we get started, press the like button and consider subscribing. Helps the channel out, and I appreciate your support. So CRE, folks, the commercial real estate market, we all know is vulnerable, having problems. Appraised values have been falling for the last 18 months, but most people assume it's only the office sector that's in the hot seat with remote work not going away. The office sector really does have structural issues, problems that extend out like a decade, maybe more, which is why office building values have been crashing. But it's not just the office sector, folks. Take a look at this. Overall, across all CRE sectors, prices are now down 22% from their March 22 peak. CRE market is crashing, or rather has already crashed, and the pain has spread beyond office to retail, to multifamily, to apartments, which we're going to look at in a minute. But it's important to realize that a lot of people seem to blow this off, that it's just commercial real estate, no big deal. Look, folks, any asset class is backed by debt, by loans. Somebody's money is on the line. And when there's leverage involved, things can go from bad to parabolic in the snap of a finger, which brings us to the most remarkable part of this story. The debt that I just mentioned, the loans, well, enough of them and the right mixture of them are owned by none other than Blackstone Mortgage Trust. And before we go on, let's just take a minute to absorb this, all right? One of the largest asset managers and private investment companies in the world, a company that is supposed to specialize in investing your money. Realize if you have a pension, for example, it's possible that some of your money could be at risk here. Blackstone's clients include more than 90 million pensioners in the U.S., also major endowments, sovereign wealth funds, and retirement systems. So once again, people shouldn't just discount the commercial real estate crash as being unimportant just because it's not affecting the residential side the same way that it did back in '08. And where am I getting this from, by the way? How do I know that Blackstone's in trouble? Well, to be clear, it's Blackstone Mortgage Trust, one of their real estate investment trusts, not their BREIT, but their BXMT. That's the ticker symbol for the REIT. A REIT, by the way, is a real estate investment trust. So here's what happened, all right? Muddy Waters, a hedge fund and a premier research firm who specializes in short selling, released a research paper a few days ago that their analysts put together, all right, called Blackstone Mortgage Trust, Inc. Here comes the cliff. Here's what Fortune says about this. One of Wall Street's most feared short sellers takes aim at Blackstone Mortgage Trust, warning it could be completely wiped out by rising losses. This article was published on Wednesday, December 6th. Now, instead of reading this, though, I'll just give you the cliff notes, all right, as I have the actual report here. Carson Block, the founder of Muddy Waters, releases this paper. Then he announces it at the SON conference in London 2 days ago, and during his interview there, he made some stunning claims, all right, how far up Shack Creek Blackstone really is, saying it's so bad, in fact, that they couldn't resist taking out a short position on BXMT, the Blackstone Mortgage Trust, and realize betting short is extremely risky. Unlike going long, shorting a stock means you open yourself up to extreme losses. There's really no limit to how much money you could lose. So they clearly have a high level of confidence in this bet. Now, who is Carson Block? Well, he founded Muddy Waters back in 2010. He made a name for himself doing this exact thing, making large, extremely profitable bets against public companies that he claims are about to go under, or some type of black swan's about to happen to them. Here's what Fortune says about him. Founded in 2010, the investment firm burst onto the scene in its first year of operation by shorting shares of China's Rhino International. Block warned at the time that the company was misstating its revenue and making misleading claims about its status as an industry leader in key steel markets. Rhino International was eventually delisted from the NASDAQ, and the CEO and his wife, the company chairman, faced SEC charges of overstating revenues and diverting money for personal use, obviously making a killing off of that short position. Look, he's notorious in the industry and someone you don't want to be on the wrong side of. If you're a public company, the last thing you want is Muddy Waters releasing a paper about your company. Well, that's exactly what just happened. And the research paper was about Blackstone Mortgage Trust. Here's their share price, by the way, after Carson Block announced this. BXMT crashed, investors pulling up stakes. But what's his argument? Like, what's he saying is wrong with Blackstone? Well, here's what he says. And by the way, if you want access to our research database, the link's in the description. Here's what he writes. Muddy Waters is short Blackstone Mortgage Trust, BXMT. Interest rate swaps and manipulated risk ratings to loss provisions have obscured serious deterioration in BXMT's loan book. Muddy Waters believes that starting in 2024, as an estimated $16 billion of swaps terminate, the following problems are going to be evident. First, BXMT will likely significantly cut its dividend as soon as the second half of 2024. At present, so far, we expect BXMT to cut its quarterly dividend by at least half. Second, we think large numbers of borrowers will be unable to refinance and repay them. Third, BXMT is at risk of a liquidity crisis. And here's the best part. He writes this. Even assuming that the Fed begins to cut rates, BXMT's losses on its $23.2 billion net book value of loans could reach around $2.5 billion to $4.5 billion. BXMT's market cap, which is currently only $4 billion, is at risk of being completely wiped out by these losses. These losses would be in addition to BXMT's existing loss provisions. Now, we've been talking about this for like the last year, how the coming wall of corporate and CRE loan maturities will cause some type of credit event to play out. There's just too many loans that are getting ready to roll over and reset, and that's exactly what Carson Block's betting on. Now, if you read his full report, he goes into much more detail about why he sees Blackstone being screwed, basically. He's obtained a breakdown of their loan book, and he knows how bad a situation they're really in. But it's not just them. It's not only Blackstone. Blackstone's technically a shadow bank, but what about regular banks? Small banks in particular are in a similar position. It's why banks have been writing fewer and fewer new CRE loans. They're limiting their exposure, or they're trying to limit their exposure. Just look at the breakdown of CRE lending in this country. Look where it comes from. Blackstone falls into the dark blue bar, that tiny CMBS pool. The sector that's in real trouble, though, are the banks, the green on these bars. Small banks account for almost 70% of all commercial real estate loans outstanding, where these banks, actually hold the loans on their books instead of just selling them off after they close the deal. And the scariest part about this, of all of this, is how badly small banks are in over their heads right now. I spoke about this on Twitter a few days ago or last week, how around 700 U.S. banks have surpassed the 2006 CRE loan concentration guidance. This means these banks are sitting on CRE loans which make up 300% of their risk-based capital. This is something that regulators came up with during the run-up to the great financial crisis, when they were seeing property prices falling and banks overextending. Well, that's the exact same thing that's happening right now. Commercial real estate is in free fall, folks. All in, commercial real estate's down 22% from peak, which means as these loans roll over and reset, the appraised value of these properties will be 22% less on average. You see the problem here, right? It's why we're already seeing so many big real estate investors just hand the keys back to the bank when their loan resets. The new cost post-maturity is just too damn high. So this brings us back to Blackstone then, all right? Are they on the chopping block? Well, time will tell. Muddy Waters certainly thinks so. And something, that's quite telling, by the way, was Blackstone's response to this. They didn't ignore it or release information rebutting the claims. Instead, they went on the defensive, attacking Carson Block for releasing the paper. So take that how you want, but realize a credit event is coming, an event that even the largest companies like Blackstone may not be capable of escaping. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.